Welcome, Bob. We are glad to have you with us. You say that diversification in public markets often fails serious wealth builders. Can you walk us through the math of the volatility drag and why even average markets returns can quietly undermine long-term compounding?
Right. Well, you've seen today. I mean, stock market drops 1,000 points, and we've seen this. The problem with the stock market is its volatility. It averages 17% volatility over the last 100 years, and that's a 60-40 portfolio. Well, that's a lot of volatility, and yeah, you get some great companies in there, but the bottom line is volatility destroys compounding. And none of the ultra wealthy, traditional financial advisors will tell you to invest in what's called 60-40 portfolio, 60% stocks, 40% bonds. But none of the billionaires do this, not a one. They don't do this model because it's too concentrated and too volatile in the public markets. So you think you're buying an index, right? So let's say people will buy an index like the S&P 500 or the Dow Jones 30, and you're buying 500 or you're buying 30 stocks. The problem is with these indexes. So if you buy the S&P 500 index, you buy SPY or an ETF or a mutual fund with 500 stocks in it, a third of that purchase is 10 companies, a third. So it's highly concentrated in just a few companies. And by the way, those 10 companies all move together. One they all go up and down together. You ever notice when your screen goes red, right? Everything goes red. It's like that's the problem with the public markets.
Well, I totally agree with you, and that's why I certainly encourage the investors we work to do a 60, 20, 60 in private equities and 20 or less in public markets. So I'm right with you there.
Well, there you go.
So you said private alternatives aren't about chasing higher returns, but they're about reducing that structural risk, and I would agree with that. What does that mean to you in practice, and how do billionaires think differently about the volatility?
Yeah, billionaires are first and foremost looking to limit their downside. So here's a huge difference between the ultra wealthy and the typical, independent, individual investor. The individual investor, and I've worked with hundreds of them, right? They're looking for headline returns. Oh, this one says 20% returns and this one says 18. I'm going to go for the 20 because I want to make more money. And what they're not showing you is risk-adjusted returns. And that is far more impactful. Losing money is far more impactful than maximizing your returns. So Warren Buffett is famous for saying the first rule of investing is don't lose money. The second rule of investing is don't forget rule number one. So the wealthy are focused on risk. They are focused on minimizing losses and more than maximizing returns. And by minimizing losses, you do maximize your returns.